Lecture 3, the structure of the market. And we get into it. And the purpose of this lecture is to help you understand what makes up the structure of financial markets so that you're in a position to trade with a lot of clarity and confidence. And with that, we begin looking into what market structure is. Pardon me for that. And so we are going to understand the market structure in 5 lights, okay? 5 core components. The first one is market types, order flow, liquidity, price formation, market mechanisms. Now, market structure is more of like a system. It's more of like a framework, okay? It's more of like a mechanism. And with this system, there are several movable parts, okay? There are things like rules, there are things like, participants, there are things like processes. And all these things, what they are helping you, they facilitate effective trading and they facilitate proper price setting. Okay, so they are very important. So we move on now into looking at these core components. We have the first one, market types. Again, do not get confused with what we looked at or into during the previous lecture, lecture 2, where we were looking at the different tradable markets and we had examples of forex, stocks, options, futures. When we are looking at the market types at this very moment, it is very different in this manner. Okay, it is the market types in regard to how exactly trading happens. Okay, who facilitates that? Okay, where this happens, things of that sort. So in that light, we have 2 market types. We have the trading that happens on the exchanges. We have the other one that happens over the counter. Okay, and so there's one that happens over the exchanges or within the exchanges. Okay, it is more centralized. There are more rules into it. Okay, it is highly regulated. There is not a lot of flexibility involved into it. Involves a lot of standardization in it. And the tradable markets that fall under that, the tradable asset classes, they are stocks, futures, options. Okay, then we have the next one, over the counter. This is more decentralized. It is direct dealings, okay, via brokers, via market makers. But now here, what we have more flexibility, but less regulation. A good example is FX markets, and some CFDs fall into that category. Moving forward, we have order flow. Again, what we are looking at, it's things to help us understand the structure of the market. And this is a second component, okay? Order flow. From the very mentioning of the word order flow, we can derive the meaning from there. It is a flow of orders, flow of buy and sell orders entering the market, into the market. But now, these buy and sell orders, they are classified in 3 categories. We have market orders, limit orders, and we have stop orders. We look at the market orders. Now, think of you being in a marketplace where maybe an auction is happening, or you're going to buy a particular a particular asset. Pardon me for that. Okay, and you do not have the luxury of waiting until maybe certain conditions come into the market, and then you get a fairly good price for you to purchase your asset. Since you do not have that luxury, you are willing to be filled, you're willing to buy that particular asset at the current market price. That is what market orders are. Okay, so the executions happen immediately at the current price. Then we have limit orders. Now, here you have the luxury of waiting and setting the price that you want. And always it should be a better price than what you would have been filled at using the market orders. Lastly, we have stop orders. Okay, so stop orders, their key obligation or their key purpose is to help you mitigate your losses on the downside. Now, let us simulate this into our minds. You have executed your buy order for an asset class like gold, or maybe something like Euro USD, okay, for the FX. After buying gold, what you do, you will on the downside of it, just below your entry price, you leave a stop loss, you leave a stop order there, just in case the market does move into your favor. It will help you mitigate your losses, okay? And on and on and on. And so what the order flow actually does, it keeps driving price changes as orders match. So because for every buy order there has to be a sell order, that kind of a thing. And if we have a surge in buy orders and do not have a surge in sell orders, that creates kind of an imbalance. And all these are conditions which facilitate proper trading in the markets. Okay, so we move on to the next key core component of understanding the structure of the market, and this is now liquidity. Now, we are going to we are going to hear different versions of liquidity as we progress, but from this very moment, I want us to keep it very simple, and we have this version of it. You remember in the previous lecture, we were looking at the different key players in the markets, and we had three categories. We had the retail traders, with the institutional traders, and also we had the market makers. And for the market makers, we looked at them as the key providers of liquidity. So liquidity is just the ability to buy or sell an asset without actually significantly affecting its price. Okay, and liquidity, it goes hand in hand with the amount of trading volume that is there and the amount of participation which is there. So you expect to have high liquidity if there is a huge trading volume and if there is a good amount of participants activity in that particular market, and the vice versa is true. Low liquidity if there is low trading volume and low participation or low activity from the participants. Okay, so high liquidity, those are the favorable conditions that you want. You want to be in a market that has a lot of liquidity, because if there is a lot of liquidity, you're going to have good movements, good displacements, okay, from one price to the other. And those displacements, that is what you want for you to make money, okay? Again, this high liquidity comes with an added advantage of tight spreads, okay? These are now the expenses that you have to incur when trading. Also, it comes with fast executions, unlike low liquidity, where we have wide spreads, you have slippage risk, and other things of that sort. Moving on forward, price formation. Okay, so for price formation, we're just going to keep it very simple. You've already seen in our charts or in this, in this trading space, we only have two instances. Okay, two conditions: buying or selling. It's only that simple. Okay, and so whenever we are buying, we have a condition, we have a situation where prices are rising and rising. Whenever we are selling, we have a situation where prices are falling and falling. So what is this that facilitates, this increase in prices, and prices are just rising and rising or falling and falling for a selling instance? We have a number of things that facilitates that. One is the supply and demand, of course. We have more bids, the bids are being placed more and more in the markets, and so that keeps pushing the market higher and higher or lower and lower. Then we also have other external factors, things like news releases, key economic data. And so the perception that will be accrued to those particular news is they affect this or a particular asset or a particular market, and so we end up having those displacements, whether on the upside or whether on the downside. Okay, we just keep it as simple as that. So a good example is what is given there: a strong earnings increase Apple stock demand, raising its prices. Again, we're going to look into the inner depth of that as we look at the strategies later on. Lastly, we have market mechanisms. This is the last key core component that is meant to help us understand the structure of the market. Okay, and so this market mechanism, it basically answers what ensures trading happens smoothly. And we have a number of things that we are going to look at here. We have a thing that is called auction system. It is derived from the understanding you already have of an auction. Okay, so we have matching of buyers and sellers in a market, and particularly more streamlined to stocks and options. Okay, so that is one of the systems, one of market mechanics there. We have continuous trading, real-time executions in FX and futures. Yeah, so we also have clearing houses. These are the firms which guarantee trade settlement in exchanges. Okay, you remember we were looking just a while ago the types of markets, and we had the one that is geared to exchanges. So now clearing houses come in there. We have brokers stroke market makers, and these of course they facilitate OTC, all over the counter trades, and they as well provide liquidity. So that is all we are going to look at, just to help us give a bit of understanding about the market structure. It was nice having this lecture with you. See you in lecture 4.